Good morning. This is CRE360 signal for Thursday, November 6th, 2025. Commercial real estate deal activity has plunged to its lowest levels in years, but not all sectors are suffering equally. According to Moody's Analytics, total CRE transaction volume fell 37% year over year in the third quarter. However, data centers and retail properties are bucking the trend, with data center deals up 14% and retail transaction volume climbing 9%. In contrast, office and multifamily continue to contract sharply, posting 42% and 31% declines respectively. The numbers reflect a sharply risk-off sentiment, with capital concentrating in sectors demonstrating durable demand and cash flow resilience. Turning to Washington, the 2025 federal government shutdown has now set a new record, entering its 39th day. The standoff is freezing critical CRE-linked operations. Over $3.2 billion in HUD-backed project loans are stalled, and GSA lease negotiations affecting hundreds of buildings are on ice. This government paralysis is amplifying lender caution, especially in markets with significant federal tenancy, and contributing to a broader investment slowdown. Meanwhile, TREP's third quarter review points to faint signs of stability in CRE credit. CMBS loan delinquencies improved, dropping to 4.8% from 5.2%, but special servicing rates remain elevated at 6.1%. That means distress is still concentrated in office and lodging, even as industrial and retail see positive absorption. Oker's refinancing risk is front of mind. With $58 billion in CMBS maturities coming due in the fourth quarter, a key stress test for the market. In a rare bright spot, U.S. retail fundamentals rebounded strongly in Q3. Newmark reports that retail vacancy fell to 4%, the lowest since 2007, while rents increased nearly 4% year over year. Transaction volume surged to $13.2 billion, driven by demand for grocery-anchored and discount-anchored centers. This retail revival stands in sharp contrast to ongoing office and multifamily headwinds. Our take is that the CRE landscape is increasingly bifurcated. Operators and investors need to focus on sectors with resilient demand and stable income, like data centers and necessity retail. Underwriting discipline is critical as liquidity tightens and valuation pressures persist, especially in office and multifamily. Now is the time for rigorous portfolio management. Prioritize proven assets, stress test refinancing assumptions, and be ready to pivot as distress and volatility continue. Looking ahead, keep an eye on three things: resolution of the government shutdown, the wave of Q4 loan maturities, and the next round of inflation data and Fed commentary. Each could tip the scales for CRE risk and opportunity in the final stretch of 2025. This has been the Our Today Signal. For charts and the full newsletter, visit CRE360.ai. Research-driven and built for operators. Have a wonderful day.